Bourdeau from Market Compass. I'm so excited. Hey, Amelia, are you still in Florida?
Hi, yes, I'm here. I'm in Florida and we're fine from the hurricane. It was a little difficult earlier this week, but everybody is fine. So I'm excited to be here today.
Awesome. We're so excited to have you. Well, you can start sharing your screen. You sound great.
Thank you. I just want to make sure. How do I share my screen? Hold on, I'm looking. I see it here. 1 second. Start video, mute, share. Got it. All right. Continue. Screen 2. Can everybody see that now?
All right, we have it. Perfect.
Excellent. Thanks so much. Thank you for the invite. Thank you, everybody, for being on today. I appreciate your time, and I'm excited, certainly post-hurricane, to be back to markets and to be speaking about trading global macro. I focus on foreign exchange trading in the G10, so the developed economies. And what you're looking at here is just a New York City skyline. So I spent most of my career, 18 years in New York City, on Wall Street, both at the sell side at banks and at a couple hedge funds. And so that's where Market Compass was launched about a year ago in New York City. These are just a disclaimer. You know, trading obviously is risky, and only trade with money that you can afford to lose. Educate yourself and never feel uncomfortable about the amount of money you're trading with, certainly. It's my website, marketcompassllc.com. I'm just going to go over briefly where you can find me and my free stuff. So marketcompassllc.com. If you click just right on the front, there's just a Get the Guide Now. And if you just fill out your name and your email, you're going to get a free 5-series video and 1 PDF about 5 techniques that retail traders can use to navigate the markets like the big hedge funds do. So let me just get back to that in a second. I'll talk about the hedge funds. But here you can also find me on Twitter. That's more obviously daily and intraday moves at Amelia Bourdeau, my name. I do a lot on Instagram and Instagram story at Market Compass. If you watch my IG story, I tend to update you on markets throughout the day on IG story and put some charts up there too, because I just think it's fun and it's an easy way to capture the essence of the market. And we'll be adding more videos on YouTube. My channel's the company name, Market Compass, on YouTube. My background, and I want to tell you this, not to be boastful, I just want to tell you this, how I approach markets so quickly. That's a subway station. That's the 19 subway station at Wall Street. I took that picture, and when I worked at Deutsche Bank, that's where I'd get off. That's my view every morning when I walk up those stairs to go to work. I have 17 years of experience on Wall Street. All of it is in global markets. So in foreign exchange sales, foreign exchange trading, and foreign exchange strategy. I worked on the sell side at Deutsche Bank, at UBS, Westpac, and UniCredit AGA. When I worked at Deutsche and UBS, they were 1 and 2. They were the world's largest foreign exchange traders in the world. So we saw trillions of dollars a day of flow through that trading floor. On the buy side, I worked for 2 macro hedge funds. One was Asia-based, but I went between New York and Sydney, Australia, and the other was based in New York City. I started my career at the Federal Reserve Board in Washington, D.C., and I worked in the International Finance Division. So my whole career, I've always worked international. You might have seen me with Todd Gordon, if you know him, from Elliott Wave and TradingAnalysis.com, his company. We were both, he's still on CNBC, but we both had a show together called Money in Motion, and I was a CNBC broadcast contributor. And now you can kind of catch me on Fox Business News Mornings with Maria. Okay. I want to keep going, and I'm trying to. Oh, next slide. Here's just some of the things I do. Deutsche, UBS, that's me on CNBC and on Fox. Okay, what is global macro trading? So in global macro trading, we take a top-down view across markets and economies. Market themes are very important in global macro. We look at market themes and we track the market themes, and how the market themes evolve tends to give us trade ideas and how we learn and execute trading on the market via these market themes. We look for how they develop. Very importantly, we look for potential market dislocations and or potential dislocating events. So I like to joke, but it's not really a joke. There's some seriousness to it, that global macro traders are the doomsday preppers of the trading world. We look where things can go wrong or where things are dislocated, potential mismatches, and that's what we try to trade to gain alpha. That's what we try to capitalize on. This trading strategy is discretionary, meaning it's not algorithmic based or technical, and it's flexible. So it can be used in up markets, down markets, flexible. In trading global macro, volatility is your friend. So when markets are moving, that's when global macro as an asset class shines. That's when we do really well. Hopefully that we do really well during that time. That's our time to have opportunities. And so here you're just looking at the VIX index, and I put a line at 20. The chart doesn't go currently, but we'll look next at a current VIX chart. But I just wanted to draw your attention to that line of 20. When the VIX gets to like 18 or 20, that's when we consider markets volatile. And once again, the VIX is a measure of volatility for the S&P 500. Let's take a look at kind of the types of risks that we're looking at in the market. I'm trying to just talk about, as I talk about my presentation, I'm going to talk about the types of shocks, the types of risks that we are encountering now, and these are certain types of risks that you're always going to have to deal with in the market. So we'll look at the type of shock, and we'll look at kind of how to deal with it. So the first type of shock is an external shock, and that's an unexpected change impacting the economy or the financial markets, and the shock takes place outside of the economy or the financial markets. So examples of this are presidential tweets and what we like to call on the trading floor headline bombs. That's what we call them on the trading floor. Something unexpected comes over as a headline, and we call that headline bombs, and things start moving right away. Now, let's look at the presidential tweets and some of the headline bombs. U.S. equities were moving around, obviously, on the trade war. And I just wanted to show you a chart of how much they've moved on the trade war, how much the trade war has impacted equities. So this is the S&P 500 in white and the Dow Jones Industrial Average in yellow. And April 30th, you see April 30th, the first kind of square rectangle on the chart is that was the former high in the S&P 500. And then on May 30th, after hours, I was at the gym downstairs in my building, and I set my alerts. Always set your alerts on your phone. For Wall Street Journal, it's free. For CNBC, it's free. You set your alerts for foreign exchange and for U.S. economy and for markets in general. They have a general market one, and you get an alert right away. So at the gym downstairs, President Trump tweeted an announcement that there would start to be tariffs on Mexico, starting if they didn't, somehow help us with that border crisis. And so immediately I knew what to do. The tweet came over. It was after market hours, so equities were closed, but foreign exchange certainly was open. So I didn't even care about the level. I just went long dollar MEX on that tweet because I knew Mexican peso was going to really, really weaken. So it's very important to set your alerts. But turning here back to the equity market, you see how the equity market on the May 31st open just slumped even further. When things were kind of resolved in Mexico, the equities recovered, and then we come to August 5th, the red vertical line, and that was China's FX depreciation of the yuan through that very key level of 7.0. We called this theme watching 7 in foreign exchange, and people were looking for it for a while. This was a huge technical level to break for the yuan, that the People's Bank of China set the reference rate. They manage their currency higher than 7.0. And certainly that disrupted global financial markets. And you can see on the open the next day, S&P 500 and Dow Jones Industrial Average, they just tanked. They tanked. They absolutely tanked. So that was a huge market dislocation that China kind of did to us, after we kind of retaliated with tariffs on them. And then, of course, August 28th, the blue vertical line, that's the day that China announced tariffs on the United States in retaliation for the U.S. putting further tariffs on them. So this is a trade war, back and forth, back and forth. And you see the market was lower again on that day. Recently, the market has been up, and because on September 5th, US-China announced that they were going to resume trade talks in mid-October. So the point of this chart is just to see on the days of these announcements how it really impacts equities. Here is an interesting chart. Bear with me. It looks like a lot, but it's not. It's the S&P 500, and once again, that VIX index, the measure of volatility. And I just want to show you how we've switched risk off, risk on. So risk off are the light yellow boxes, and risk on are the green boxes. So you can see the first box starting in December, that yellow box. You see the yellow line is the VIX index. Volatility just spiked in the market. This was heading into the Fed's rate hike late in the year. And I put the vertical lines of 20 and 18, the blue and the yellow horizontal lines, I'm sorry. And that just shows you the VIX is spiking way above that 20 line, and equities, the S&P 500, the white line, are tanking. Look how much they fall when volatility spikes. Then we come to the green box next to it from January to April, and we have a nice run here. The Fed starts cutting rates, and there's some down days, but we have a run up in the S&P 500, and you can see the yellow line. Look at volatility is low. So volatility is low, and equities are strong. Once again, we come to May, and that's when we had the Mexico trade war tariff tweet, and we had more problems with China and the trade war there. And so look at the S&P 500 is falling, the white line, and volatility is spiking. So the VIX gets above 18, that yellow line, and it moves to 20. That brings equities lower. And once again, in June and July, we have a nice run up. It was volatile. There were back and forth days. We had a run up here, that green box in the S&P 500. We're making new highs. And then vol is low, that yellow line down at the bottom. It's sub 18. It's well below 20. And low vol, equities are rising. And then look at August. Look at how volatile August is. Yuck. Look at that back and forth in that light yellow white box. The S&P 500's up and down, and so is volatility. The orange line is up and down, up and down. We're spiking way above 20 and coming right back below, and way above 20 again and coming right back below. And August was a difficult month because China depreciated their currency through 7, and we had a lot of also ugly Brexit headlines. Now here we are, September, the green box right at the right, and we have equities are up again and volatility is lower. So I just wanted to show you how we switch from a risk on to risk off environment in global macro, and a lot of it's driven by volatility. Let's look at the dollar. This is the dollar index and US yield. So the white line is the US dollar index, and the yellow and the orange lines are the 10-year yield in orange and the 2-year yield US in yellow. So you see the Mexico tariff tweet. That's the day, May 30th, when I was down at the gym. That was really the start of the collapse in US bond yields. You see that tweet just kind of put the nail in the coffin for US bond yields, and they start a very steep decline on that day. The dollar has remained relatively strong despite how low US yields are. So look at that. US yields are moving lower, the yellow and the orange line, but the dollar is strong compared to how low the yellow line is. You see the gap between the series, the white line and the yellow and orange line. So why is that? That is because the dollar is a safe haven currency. So when things are going wrong, both in the US and globally, we have a global growth slowdown. We have a lot of risk in Hong Kong with the protests. We have risks with Brexit. We have Germany in almost recession right now. People flock to the US as a safe haven asset. And so the dollar has remained pretty well bid, despite how low US yields are. I just wanted to draw your attention to the vertical yellow line that's dotted. That once again is August 5th. That's the day of the China FX depreciation, moving the yuan above that key 7.0 level. And look at that. That starts another major collapse in US bond yields on that day, another leg down for US bond yields. So you can see how these trade wars have really driven U.S. markets. They've played a large part in our yields falling and a large part on the days of the announcements and our equity markets falling. So it's important to watch. Now we're turning to FX performance over the summer. And this is from like Memorial Day weekend. So May 30th through August 30th. And you see these are the spot returns of the G10 currencies against the US dollar. So yen has gained the most against the US dollar. Look at that, over 3% over the summer against the US dollar. Swiss franc and then Canadian dollar have all appreciated against the dollar. And the rest of the G10 currencies are weakened over the summer against the dollar. So look at the top two, yen and Swiss franc. They are safe haven currencies. So the summer was super volatile. The trade wars were heating up. Brexit was heating up. People were debating to what extent the US economy was slowing. And so the yen and the Swiss franc, which are safe haven currencies, they do well in high volatility. They do well in times of uncertainty. They strengthened. The Canadian dollar also strengthened, which is an interesting one, and we'll talk more about that at the end of the presentation. But the reason the Canadian dollar strengthened is because it's one of the only G10 economies, Canada, that is not cutting rates. Bank of Canada has not turned dovish. They have not cut their interest rates. And so though higher interest rates are giving the Canadian dollar a bid in the market. At the bottom, Norwegian krona, British pound, Swedish krona, not unexpected. These are high beta currencies, meaning when times are volatile, high vol, these currencies do badly, especially Sweden and Norway. The reason the pound is doing badly is obviously because of Brexit. They have a lot of political trouble there, and we'll talk about that. But no, in times of very high volatility, Norway and Sweden are super sensitive to it. And so the Naki and Staki, that's what we call them in trading land, the Norwegian krona and the Swedish krona, Staki, they do badly. So, like when you wake up and if vol is high, if the VIX index is above 20, what would you do? Looking at this chart, well, you'd want to be long the yen against the US dollar, and you'd want to probably be short Swedish krona or Norwegian krona against the US dollar because, they do badly. And the yen does well in times of high vol. Now let's look at September. This is just only September. We're not that many days into September. But as we're looking at those equity charts, we had a relief rally because US and China are agreeing to meet in mid-October for trade talks. And the market is happy about this. They're relieved about this. And so it's the exact opposite almost of what happened this summer. So like 3 days into trading, this is like Tuesday through Friday, post Labor Day. Look at what we have. We have Swedish krona, the one that was doing one of the worst, the highest beta, is now at the top, gained 2% against the dollar. The pound is also up 1.8% because they had some positive news on kind of stopping a no-deal Brexit, and we'll talk about that in a minute. The Kiwi dollar, also high beta, is doing well. And what's losing out? The Japanese yen that weakened. And why did it weaken? Well, nobody needs it when safe haven is off and risk is rallying, when it's risk on, nobody needs the yen, which is a risk off currency. So you sell yen when equities are up and everything's going well because people don't need that safe haven yen currency on that day or in that environment. There's a lot of event risks near term. And as I kind of mentioned at the start of the presentation, global macro traders watch event risks because they give us a map as to what can happen and how our market themes will develop. It also gives you a map if you're a technical trader and you're not a global macro trader. It gives you a map as to which days in the market could be more volatile than other days. So that's great for your alpha too, even a technical trader, meaning technical traders, when things are moving, your levels are breaking, you're watching your levels. And it's good to know in advance the days and the times that markets may be moving around more so than others. So you can plan your trading week, you can plan your trading month around some of these days are going to be more volatile. All right, so, and I just wanted to say about that may give you, when you know the days that are going to be more volatile, when the risk events are happening, that may give you opportunities to trade, or it may give you opportunities to hedge your portfolio, to not trade, to hedge, and to stay away on those days, depending on what positions you already have on. So what is coming up? ECB and the Federal Reserve. Those are the big near-term risks. So let's start to take a look at those. Let's look at the European Central Bank. There we have the euro symbol, and that's ECB President Mario Draghi. This will be his last meeting. He is rotating out. September 12th is the ECB meeting, and this is a big deal because the ECB did not meet in August. They were away on vacation, and people are accusing kind of the ECB of being behind the curve. The Fed has already cut rates. The Fed has already turned dovish earlier in the spring, and the ECB really hasn't turned dovish to the greater extent that the Fed has. June 18th, Mario Draghi spoke. He was a little dovish, but people are really watching this ECB meeting to see what they're going to do. So September 12th, 7:45 a.m. Eastern Standard Time is the ECB rate announcement. 8:30 a.m. Eastern Standard Time is President Mario Draghi's press conference. The press conference is pretty volatile for the ECB, and you can watch it right on the ECB's homepage. You can also watch it on YouTube. The European Central Bank has a YouTube channel, and you can watch it there. Euro really moves around at that 8:30 a.m. press conference. Let's look at what's priced in the market. These are current implied probabilities. These are priced into the bond futures market, okay? The overnight interest rate swaps in Europe, that's what we're looking at. And this is what's priced in. So this is not a survey. This is actually what's priced into the market in terms of a rate cut. So right now, the current ECB policy rate is negative 0.4. You see that in the top right. It says current rate, negative 0.4. And if you go to the circle, that yellow circle that I circled, that's the probability of a 10 basis point rate cut. So negative 0.5, they cut 10 basis points. And there's a 54.2% chance that the ECB is going to cut 10 basis points to negative 0.5%. But look at the next line over on the left, it's still in the yellow circle, negative 0.6%. So there's a 45.8% chance that the ECB is going to cut 20 basis points to negative 0.6. So it's pretty, it's not exactly 50-50, but it's pretty close odds that they're going to cut 10 or 20 basis points. So the market's split, and that's a big deal, because if they cut 20 on September 12th in the morning, the euro is certainly going to fall. If they cut 10, the euro may not fall as much. So if you see that announcement on September 12th, 7:45 a.m. Eastern Standard Time, the ECB announces the 20 basis point rate cut instead of the 10 basis point rate cut, you know that that's going to really weigh on the euro. Euro is going to be lower immediately. Let's just take a look at how euro has been trading over the past 6 months. You see the boxes, and the boxes are kind of telling you which direction euro's been moving. So the white box, the red box is kind of, is trading in this range where 110 the figure was a really solid, that's 111 the figure, the red line horizontally was a really solid support. It kind of moved up in June and July, like 112 the figure was really the support. Then it started shifting lower. We shifted lower in August, late July and August. You see those boxes are shifting lower. We really shifted lower at the start of September, and then we're starting to come back up. So it's interesting, the start of September, we got down to a low. You see it there on the left side, the yellow circle. 109.26 on September 3rd was a low in euro. Right now, we're hanging out in the area, we're ranging between 110 the figure and 111 the figure. So we're right there in that 110, 111 range for euro. 110 the figure is a big, big support. We already broke once, as I said, in early September, but traders have wanted to push this level for a more meaningful break for a while. We just didn't really have a catalyst. That catalyst may be the ECB meeting and their decision on September 12th. Let's take a look at a long-term euro chart. Why am I showing you this? This is a 5-year euro-dollar chart. I'm showing you this because the white horizontal line, that is 110 the figure. I'm showing you this because 110 the figure is a really huge support for euro. And when it goes, there's really no further support till 105 the figure. So like 5 big figures lower, there's really no support. So you see the little red line horizontally, that was the September 3rd low in euro. That's like that 109, like 36 level. We came back above 110. If traders try to push this again below 110, the next support is at 109.36. And then we have no support in the euro really until 105 the figure. What's been the low over this 5-year period? It was January 3rd, 2017. It was kind of like, you see it at the top there in the yellow circle. 103.41 has been the low, the 5-year low in the euro. But I like this long-term chart because it really demonstrates how important that 110 the figure is for euro. There's not a lot of support underneath it. So that means when there's not a lot of support underneath it, it can move pretty rapidly. And we want to watch that on September 12th. The other thing that the ECB might announce on September 12th is a bond buying package starting for probably 12 months out at about 40 billion euros a month. They're probably going to announce that in the press conference. So the press conference is pretty important, and the press conference can move the euro around a lot. So 7:45 a.m. on September 12th and 8:30 a.m. is the press conference. Those are going to be important times for the euro on that day, and those 2 times, 7:45, 8:30 a.m. Watch euro trading. Here's euro yen. I just wanted to show you this. Euro yen's been trading in that purple box on the right. That's the latest of last week, this past week. It's been trading in a 118.50, 117.50 range. You see it got a lot lower. You see those boxes shifting down over the past 1 month. This is a 1-month chart. It actually got down to a low of 115.87 on September the 3rd. And that's important, and I'll show you why in a minute. The reason why euro yen is much higher was because, remember, we talked about at the start of the presentation how yen does well, is strong in a volatile environment. And when that volatile environment eases and US equities rise, there's no need for people to own yen because it's a risk on trading environment. So they sell yen. And so that's why starting September 4th on the chart, you see a big rise in euro yen. It's not really being driven by the euro, it's being driven by the yen. The yen is weakening precipitously against all G10 currencies, and you see it, the euro take it up higher, and now we're sitting in that 117.50, 118.50 range, that purple box. But, you know, if risk comes on and euro risk seeking comes off, so you want a strong yen, and we get a big rate cut at the ECB meeting, the 20 basis points instead of the 10, I think euro yen is going to head back lower. And I wanted to draw your attention to this. So right here, as I mentioned earlier, the low, you see it on the left of 903. September 3rd is 115.87 in the euro yen. And let's look at that 115 level. Once again, I'm showing you a longer term chart. This is back to 2016. I highlighted, or I put a white line at 115, the figure, the horizontal line. You see that this is a big level in euro yen, that 115, the figure. Now, I know we're trading a ways away from it now. We're at 117.90, but look at how quick it moved. We were September 3rd, we were 115.87. We were getting close. We're back up at 117.90. You know, this can turn and move again. And so, you know, will it move in the next week? Maybe not to that 115 level. It could move lower, certainly, and that's a great trade, shorting euro yen around the ECB meeting. But I want you to watch this level going forward. There's a lot of risk events, namely Brexit, you know, and trade wars into the year end. And so this 115 is a big level. You can see that there's not really any support, once again, below that 115. Let's take a look at the Federal Reserve. There's Jay Powell, the embattled Federal Reserve chief. He has been not responding to President Trump, but President Trump has certainly been very critical of the Fed, which is unusual for a president. The Fed's rather embattled right now. And he has not been, Jay Powell has not been a great communicator with Wall Street, not a great communicator with the market. And that's been problematic. The Federal Reserve meeting is September 18th. 2 p.m. is the announcement, Eastern Standard Time, and 2:30 p.m. Eastern Standard Time is Jay Powell's press conference. And because, as I just mentioned, Chairman Powell is not a great communicator with the market, that press conference tends to be fairly volatile. It tends to move around U.S. equities. It tends to move around currencies. It tends to move around bond yields. So when you're not a clear and concise and good communicator with the market a little bit punishes you for that. And that's what happens during the Powell press conferences. That's what's been happening. Markets become volatile, markets move around. Let's look at the Fed funds futures. Once again, these are what's priced into the market. This is not survey based. This is priced into the market right now. So the top line is the September 18th meeting. And currently the Fed funds rate, the Fed funds effective, you see it up there at the top right, it's 2.13%. It's based on the range of 2 to 2.25%. And so the yellow circle is what the market expects. So the market expects a 92.6% chance, that's priced in, of a 25 basis point rate cut, bringing the range down to 175 to 2. If we moved over to the left a little, it only expects a 7.5, like 7.4% chance of a 50 basis point rate cut. So we're pretty sure that we're only looking at a 25 basis point rate cut for the market on September 18th. But once again, that press conference will be pretty volatile. Fed speak over the past, say, month. Chairman Powell actually had a big speech at Jackson Hole at the end of August, and it was totally overshadowed that day by China trade war tweets and headlines. And so his message kind of got lost in the mix. But some Fed officials have come out for more easing. Some have actually dissented at the rate meeting about the rate cuts, not wanting any rate cuts. And the market has been repricing itself week to week, debating whether there's going to be a 50 or 25 basis point rate cut. We've settled nicely in the 90 percentile of a 25 basis point rate cut. So that looks like that will stabilize the market. But, things can change up until that rate, meaning September 18th is a long way off in market terms, but I want you to keep it on your radar screen. Now let's look at a Fed meeting scenario analysis. I just want to show you kind of how the market thinks, what can move on Fed day. So if we get the first scenario is the Fed cuts 25 basis points, and that's what's expected. As I said, there's a 92.5% chance that they'll cut the 25 priced in. So the Fed cuts 25 basis points. They're not too dovish or gloomy on the outlook in the statement of the press conference. So what's going to move? U.S. equities are going to move higher. Why? Because U.S. equities wanted a rate cut that supports equities, and Powell isn't too gloomy on the outlook for the economy. So great. That's a sweet spot for U.S. equities. Economy is okay. Fed's cutting rates. Equities higher. So U.S. equities are going to be higher on that. U.S. yields are going to be stable to slightly higher because the rate cut was priced in and the outlook isn't too gloomy. And then the U.S. dollar is going to be stable to higher. It's going to follow U.S. yields. So U.S. yields are stable. The U.S. dollar is going to be pretty stable. Now, what if the Fed surprises and the Fed cuts 50 basis points on the day? That's a surprise. Okay, so U.S. equities are probably going to be higher because it kind of turbocharges the equity market. The equities are thinking, okay, great, 50 basis point rate cut. Let's move higher. Global equities are going to be mixed in that situation because global other economies are going to look at the U.S. and think, oh, the Fed is cutting 50 basis points because they're worried about the growth in the United States, and that's going to weigh on the growth in the United States. If it slows, it weighs on the global economy because the U.S. is the largest economy in the world. The second largest is China. And so that weighs globally. So U.S. indices higher, global indices probably mixed. U.S. yields are going to go lower. The U.S. dollar is going to go lower following yields, and gold is going to be higher. Why is gold higher? Gold is higher because it's a safe haven asset, and people are going to be worried about the global growth outlook. So they're going to buy gold, they're going to buy yen, they're going to buy the Swiss franc against the dollar because it's going to be like a little bit of a flight to quality because global growth is slowing. So I just wanted to go through that and just show you what, depending on the scenarios for the Fed, how asset classes can move on the day and what you should be prepared for on the day. And even if you're not trading this on the day, it's interesting to keep this kind of cheat sheet on what could happen on the day, the scenario analysis handy, and watch what happens on the day. And if you're around, you have time, watch that press conference. It's going to be live on the Federal Reserve homepage for free. You can watch the whole thing. And it's interesting to hear Powell speak. It's interesting if you have your trading systems up to watch how markets are moving while he's actually speaking. It's a tradable event. It's also an opportunity for you to watch how markets are moving. So keep this scenario analysis handy. We're going to talk about the United Kingdom and Brexit. It's pretty difficult. It's like the gift that keeps on giving for macro traders, though, because there's so much going on and it creates so much volatility. And as macro traders, we like that. I'm coming back to the types of risk the market faces. I mentioned headline bombs and presidential tweets as external shocks initially with the trade war. And now we're looking at this type of risk. And this type of risk has really been highlighted by Brexit. It's a little bit highlighted by the trade war too, but I just wanted to make it very clear. The type of risk event that Brexit is turned into is prolonged uncertainty. So prolonged uncertainty in financial markets just wears them down. Market sentiment starts to sour over time, and this begins to impact and leak into the real economy in a negative way. And have we seen that in the UK? We have seen that in the UK. 3 years ago, it was like June 2016 was when the referendum was held, and the people of the United Kingdom voted to leave the European Union. That was 3 years ago, and Brexit still hasn't been delivered yet. And what's been happening over that time period is it's negatively impacting businesses in the UK, both international businesses who are located there and domestic British businesses who are there. They can't make plans. They can't start to make business plans or capital spending plans or hiring plans because they don't know if they're going to be in the European Union or not, if they're going to leave in an orderly way or a disorderly exit, and how things are going to exactly work once they're out of the EU. The British government has provided absolutely no clarity on any of this. And so that started to hit GDP via weak capital spending, weak investment plans for businesses. And so the Q2 GDP in the UK was negative this year. It just came out about a month ago and it was negative. So they're already experiencing negative growth due to the prolonged uncertainty because of the Brexit situation remains unresolved. Monday is going to be a big day this Monday for sterling. Sterling is the nickname for the British pound. The other nickname is cable. When the British pound is traded only against the US, it's called cable. Sterling is it's the British pound sterling. It's headline risk day for the pound on Monday. Why? Well, Parliament could be suspended. So the current PM, Boris Johnson, asked the Queen with her permission to suspend Parliament. She did. So Parliament is going to be suspended, it looks like, starting September 12th. So Parliament has very little time to try to do something. It's a big deal that he suspended Parliament for 5 weeks because that takes them almost to the current Brexit deadline, which is October 31st, Halloween. That's a big deal because they can't do anything about it once they're suspended. So the reason it's speculated, and it's written all over British newspapers, everybody's been following the story really closely. The reason why he suspended Parliament was to try to push a Brexit deal through and not get it blocked for the end of October, which is the deadline, October 31st. And he felt without Parliament there, apparently, he can kind of just, if there's no deal done, he can just take the UK out of the EU because there's nobody there basically to stop him in Parliament. Well, as you might imagine, that didn't sit well with Parliament. So they introduced a bill blocking on Friday a no-deal Brexit, which was probably going to become law on Monday. So we'll know very early Monday morning our time. But the bill's already been introduced. It's already in Parliament. It's already voted for. It has to become law. That looks like it's going to become law on Monday morning. It has to become law before September 12th. That's when they're suspended. So the bill blocks a no-deal Brexit if it becomes law. It doesn't block a no-deal Brexit from happening 100%, but it prevents the government from pursuing this outcome, basically. It prevents Boris Johnson from pursuing this outcome on his own. So why doesn't it 100% block a no-deal Brexit? This bill says that by October 19th, if there's no negotiated deal with the EU to leave by October 19th, that the Prime Minister, Boris Johnson, has to go to the EU and request an extension until January 31st, 2020. That's what this bill says. So why does it not 100% stop a no-deal Brexit? Because it's not only up to the United Kingdom. The EU, if the United Kingdom goes to the EU and asks for an extension on October 19th, the EU can say, no, I'm not going to extend it. Or they can say yes. So and that's why it looks like Brexit could be extended now till January 31st, 2020, but there's no guarantee of that. It's still super volatile because the EU could not agree with that and say no. All right, so the Prime Minister, Boris Johnson, is also seeking to trigger a general election. This could happen on Monday, not the general election, but him triggering a general election could happen on Monday. So Monday is like a huge day in the UK. So you want to watch the pound. There's a lot going on Monday, September 9th in the morning, our morning early, which is already, obviously they're 6 hours ahead of us. So you want to be up early watching the UK on Monday, September 9th, trading the pound. Yeah, so the reason why Prime Minister Johnson wants to trigger a general election is because he wants to reinforce to Parliament that he has a mandate to carry out the will of the people, which was to leave the European Union. And so it's pretty risky to trigger a general election because he may lose. So we may lose the government as well in the UK in October. If he does trigger a general election on Monday, the election takes place like October 15th. Okay. And remember, October 19th, according to the bill, is going to be the day that 4 days later is going to be the day that the Parliament has to decide whether or not to go to the EU to ask for an extension. So what you can take out of this is Monday is going to be very volatile for the pound this Monday, and October is going to be a terrible month for the pound. It's just going to be very volatile the month of October. There's some Brexit scenarios. I can leave that with you on the way out. I don't have to go through all of them. It's pretty technical. The key obstacle I just want to raise to the withdrawal agreement, to the negotiation between the UK and the EU, is the Irish border backstop, and that's a hard border, which is not a hard border. They don't want to put a hard border between Northern Ireland and Ireland. So Ireland is in the EU. Northern Ireland would go with the UK and be out of the EU, and this is a problem border-wise, okay? And that's what a lot of the negotiation is hung up on. Let's look at sterling. This is the pound. So the pound is the white line. When it's moving higher, the pound is getting stronger against the US dollar. And when it's moving lower, the pound is getting weaker against the US dollar. So recently, like the past 3 days, you look at all the way to the right side of the chart, the kind of light yellow box in September, 122.94, you see the right axis. The pound has been higher on that bill that Parliament introduced, kind of trying to stop the no-deal Brexit from taking place. Now, that's super positive news. No-deal Brexit would most likely, in the very short term, be devastating to the economy, which is already in recession. Well, which already has 1 quarter negative growth, I should say. But look at the pound rally. I mean, it hasn't got up above 124, the figure. It pushed up above 122, the figure, but you would think on news like that, it would rally more. It really didn't. Maybe Monday, when the bill becomes law, it will rally more. But once again, Boris Johnson could trigger a general election on Monday, which is going to introduce more uncertainty to the market. And that might have pound hanging out here around 122, 124, the figure a little longer. It's obviously been falling. You see the boxes are moving lower, lower, lower. The pound has weakened dramatically over the spring and especially over the summer as Boris became PM and the Brexit issues heated up. That 120, the figure, is a pretty significant level on the pound. If you see on September 3rd, on the left side of the chart, you see the low, it's written on September the 3rd, 119.59. We pushed below there once, got to a low 119.59, downside break to that 120 level. It's a big level. And so normally with big levels, kind of what you see in trading and trading foreign exchange at least, the market tries to test it a couple times before there's a decisive break when it's a very big level. So we've already broken it once, may test it again, and the third time really go through more meaningfully. So on bad news Monday, watch 122, the figure, I wrote it on the left, 120, the figure in the pound, 119.59, the September 3rd low. Those are the support levels. If the pound starts to fall on Monday on the bad news. If there's good news on Monday, meaning the bill is passed to block Brexit temporarily, and maybe Boris is unable to trigger a general election, 124, the figure topside break would be significant. If we get we're hanging out like 120, 124. I know that's like a four big figure range. You can trade the range, but if there's positive news Monday and we break topside 124, it can run a little further up to that, like just below like 125.97 area, the top of that green box next to it. So I just want to show you what's been going on recently in the pound. I just wanted to show you a longer term chart. The 120, the figure, is a very significant level in the pound. I just want to show you this. Look at 120, the figure. It's the horizontal white line I marked. We traded once below it, 119.59 on Monday. Look at this chart of the pound all the way back to the 1970s. Okay, the low in 1985, the yellow circle was 105.20 in the pound. You see very clearly the 120, the figure line. There's almost no support below it. The only support really is at 105.20 back in 1985. This is a huge level if this breaks, okay? Now, I'm not saying it's going to break Monday, but there's a lot of Brexit things coming up, a lot of Brexit events coming up, a lot of Brexit uncertainty. And so in macro trading, when we identify a huge level like this is a multi-decade level that hasn't broken meaningfully, meaning we actually broke it on Monday at 119.59, but I mean, it hasn't broken and kept going, okay? And so we just want this on our radar screens. We want to watch this. We want to check this on a daily basis to make sure, because when it breaks, it's a big break. It could result in a large downward move in the pound. Why does everybody care so much about Brexit? Because it was a dislocating macro event back in 2016. I'm just going to really quickly show you this very fast. So June 23rd, 2016 was the referendum date. Here's some headlines from the day from the Guardian UK, a newspaper there, a prominent newspaper there. A look back on the referendum night. UK votes to leave the EU after dramatic night divides the nation. 51.9% vote to leave, 41.8% vote to remain. David Cameron, the PM at that time, resigns after they voted to leave the European Union. It's a big event. It's a big deal. This is how the pound was trading on that night of June 23rd, 2016. You see it trades all the way up to 150, the figure. So think about that. The pound's at 122, like 90 right now. In 2016, the day before the referendum, it was trading at 150, the figure. Look at how much they've lost on the pound because of Brexit. Okay, so it's moving up to 150, the figure. Traders, even though the polls were 50-50, were kind of convinced that they wouldn't actually do it. The people wouldn't actually leave the EU. And we were wrong. And traders, they voted to leave the EU. And so that was the referendum result. When the referendum vote was released and it was leave EU, the pound tanks. Look at it. Falls over the next day and a half, 14.78% in a day and a half. So huge move in the pound that day. That's why we were watching Brexit still. And overnight on that day, the 23rd of June, 2016, overnight, global equities lost $2.1 trillion in value overnight. So what's the point of this? It's a big move. And so when Brexit is still going on and it's still uncertain, we just want to monitor it because it caused giant market dislocation kind of the first time they held the referendum. What else am I watching? As I said, I like to look at big levels. I like to look at things that can move. This is Kiwi CAD. This is the New Zealand dollar against the Canadian dollar. This is a chart, a 5-year chart, but don't let that dissuade you from near-term moves. So when this line is going higher, the New Zealand dollar is strengthening against the Canadian dollar. When it's moving lower, the Canadian dollar is strengthening against the New Zealand dollar, okay? So right now, I kind of mentioned at the beginning, over the summer, the Canadian dollar was really strengthening against the US dollar. It was also strengthening against other G10 currencies. And the reason why is because Bank of Canada isn't cutting rates. They're not dovish, they're not cutting rates. You can argue that's a policy mistake, but in any event, they have higher bond yields and they're not cutting rates, and that's supporting their currency. So Canadian dollar is appreciating against most of the G10 currencies, and New Zealand had a huge rate cut. They cut 50 basis points earlier in the summer to kind of get ahead of the global growth slowdown, and that surprised the market. But, you know, good for New Zealand for trying to get out in front of something they see coming. And so that weighed on the New Zealand dollar. And so look at this, continues to trend lower, Kiwi CAD. I like to short it. 84, the figure, was a significant downside break. That's that red line there. And traders could try to push this cross lower. It's gone to multi-year lows. You see we're back to 5-year. We're almost like at 5-year, not quite at 5-year lows. We're like at 4-year lows right now. You can see the orange, the yellow circle. The low was August 24th, 2015, 81.93 was the 5-year low. I think we could push it to there. You know, if Canada stays not dovish, if Canada doesn't turn dovish in the next 3 weeks before their October policy meetings, this is like only like a 3-week trade here. We want to see if it moves. You know, we're going to be watching, I'm going to be watching this over the next few weeks to see if this can move lower towards that, like, say 82, the figure, more towards that 2015 low. So your targets are 83.30 and the 81.93, the 2015 low. So I'm watching this to move lower. And this is an example. Bank of Canada is not dovish, and the Reserve Bank in New Zealand cut 50 basis points. That's the rationale for this trade. All right, so overall, I mentioned the types of risks. There's external shocks, there's prolonged uncertainty, there's event risks, certain days that can trigger volatility in the market that you should be aware about, whether you're an equity trader, a technical trader, an FX trader. You need to be aware of those days. Why? Because in trading, you need to be able to control what you can control. There's so much that you can't control on a daily basis, just in life and in the market in general, but those things that you can identify to control and those event risks that you can set up on a calendar are going to be important to your trading, to either initiate trades or to hedge your book and to not trade that time or day, to preserve your capital. So how can you combat market uncertainty and event risk? I have a webinar, the Global Macro Event Risk webinar. It's held monthly with updates in between that are emailed out. And I go over in an hour all of the event risk coming for the 3 weeks ahead. And I kind of give you trading scenarios to help you navigate that event risk. Okay, we watch for big levels. We're watching the days, the times where you can find the information out. What are your trading scenarios into the event and out of the event? That's what we look at in this Global Macro Event Risk webinar. How does it benefit you? It benefits you whether or not you're a macro trader or a foreign exchange trader. It adds to your trading skill set. It's going to give you a set calendar and time for when volatility could be high or low depending on the event, and that creates opportunities to trade or to hedge. It's going to take you around the world. It's going to help you look for opportunities around the globe to trade. It brings Wall Street analysis, obviously, to the individual investor or retail investor. So when I was at UBS, especially, which is Swiss Bank, we at the time were we went back and forth over the years I was there, number 1 and number 2 of the world's largest foreign exchange traders. And also during the time, but which is no longer true, the world's largest, or the largest trading floor in the United States at the time. And so my responsibility there was to run on Mondays the weekly morning trading meetings. I ran them every day, but on Monday we had a huge meeting, cross-asset meeting, had like about 500 people in the room and another 500 around the world dialing in all the trading floors. And so I ran that meeting, and what we did was we looked at opportunities to trade, opportunities for volatility, identifying where the risks were. And that is largely what this Global Macro Event Risk webinar does. It brings that Monday morning trading meeting, cross-asset on the trading floor, to you as the individual investor. I'm bringing institutional research to you individually to have that opportunity to learn what's out there, to see the risks, and it helps to help mitigate the risks around your trading. How do you access it? You can go to www.marketcompassllc.com. That's my website down at the bottom. You go to the webinar tab, you hit webinar. There's a video there that kind of explains more about the webinar. There's also some text there that'll let you know what's going on and how, again, it can help benefit your trading. So go to the webinar tab, watch the video. If you scroll all the way to the bottom of the page, there's a subscription option, monthly and annual, in blue boxes. So today and tomorrow, I am giving you a promo code, which is BREXIT. BREXIT, all lowercase. If you want $100 off the annual subscription rate, here for Anka's audience and my audience here today, I'm super excited to offer this to you. So $100 off the annual subscription rate. It's good until Sunday at midnight Eastern Standard Time. So this Sunday, Eastern Standard Time, midnight, it's going to bring the annual subscription to $300. I'm going to take $100 off for you guys. And that comes out to only $25 a month to access the global calendar, what's important, the event risks, the scenarios around the event risks in terms of the big levels, and how to trade them. So once again, promo code BREXIT, all lowercase, Sunday evening to midnight Eastern Standard Time. I didn't put my email up here. If you have any questions before Sunday night, email me. I'm at amelia@marketcompassllc.com. Feel free to email me and ask me questions. And I just wanted to lastly put up how you can access my stuff. Once again, that's me on Twitter, Instagram story. I do a lot on Instagram story, so make sure you watch that. And we're going to have brand new videos coming on YouTube as well. You can also just go to the homepage and sign up for free content right there. It's going to give you a 5-video guide over the next kind of 10 days. They're going to be released to you on 5 techniques to trade like big hedge funds do. So I did work at big hedge funds, and I did work on the sell side, and big hedge funds were my clients. And that was exciting to kind of see the different styles of trading and learn those through a client perspective. Once again, I just want to leave you with, the markets are really volatile, and I think that this volatility will continue through year end. And although that creates challenges and risk, it also creates some opportunity. And that's what I look to identify by my event risk guide and my event risk webinar. Thank you so much, everybody, for listening to me today. I appreciate your time, and I hope you all trade well. Thank you.